Today is Saturday, February 1st, 2025, and Friday I was down pretty bad, although for the week I think I am still green. I was down almost 2% and then a little over 1% on the overnight market, so about 3%-ish. And of course, this is on a day where the NASDAQ was down slightly, 0.15, but then down 0.5 in the after hours market. And for the week, I believe the NASDAQ is down 0.44, so slightly in the red for the NASDAQ. For the month, it is basically flat, but slightly up 0.79. Year to date, it's only up 1%. And of course, for me, I am up 0.8% for the week. I am up 17% for the month. And year to date, I am up 18.5%. So still outperforming the NASDAQ, which is a good sign. And this week, I almost hit $150,000 in my Robinhood account, but unfortunately, it stopped at around 147, and then it came all the way back down to 141. So it is what it is. I still expect to hit 150 maybe by March. Now, there's a ton of things that happened during this week that I have to cram all into this video. So the first thing that I wanted to talk about was how I wasn't able to get all the hedges that I wanted for February. So I remember in January, maybe I mentioned it briefly that I was expecting February to maybe not look so hot. And so I was telling myself I should really hedge, I should really do something, because I know every time I post one of these videos where I say I'm going to hedge and do all this and that, I end up only hedging a little bit or not. And then my portfolio takes a huge swing downwards. And it seems like that pattern is repeating itself, because I did have one Palantir covered call that I had sold for about $105, and then I closed it for about 34, 35. So yeah, I did make a little money on a Palantir covered call, but hopefully because everybody has somewhat expected February to be a bad month, we'll start off with a big swing upwards to try and trap all of those early sellers. And then, of course, the rest of the month we'll have that downswing. But, of course, I'm just going to go with the flow. If we do have a big swing upwards early February, I will be looking to hedge, most likely through call credit spreads, most likely, but I can't promise anything. And if you notice, I also did buy some more WYNN. If anybody has seen my X, you'll know that I did buy 50 shares at around 86.60. I think WYNN could easily hit 100, but another reason why I decided to start a position in WYNN is because it somewhat fits into my broader thesis as to what I think will happen in the market. So if any of you guys have seen my previous videos, you'll know that I think the consumer stocks and Chinese related stocks and maybe even consumer staples will see a recovery, and of course energy, while some of the other stocks that have been high flyers kind of take a breather, which reminds me of another post that I had about how I believe it was Monday when we saw Nike up, TLT up, Pepsi up on a day where the market was in deep red. Like I said, if any of you guys have seen some of my old videos, I did mention that we could see a scenario where Nike goes up on a day where the rest of the market goes down, which doesn't really make sense because it's a consumer discretionary, very cyclical stock. But we did see a little bit of hints of that. And of course, it fits into that broader thesis because Nike has a lot of exposure to China along with WYNN. And if you pay attention to some of these other consumer stocks like Burberry, which is up 21% year to date and 41% the past 3 months, which is just ridiculous. And of course, other consumer stocks like VFC, which is up almost 24% past 3 months and is up almost 20% year to date. It really does seem like a lot of these consumer stocks, heavy exposure to China and a lot of Chinese related stocks are seeing some recovery, which is one of the reasons why I decided to buy WYNN. And of course, briefly looking over the financials, their free cash flow per share was around $8 and their earnings per share was around $8. So it seems very undervalued at the moment. And correct me if I'm wrong, but in previous years, their free cash flow per share was in the negative. And so recently, that is now in the positive. And recently, they have been buying back a lot of stocks. So I'm just seeing a lot of good things for WYNN and thought it would be a decent dividend stock in the future years. Another thing I wanted to talk about today was how Robinhood finally released futures and stock index options on the app. Obviously, I'm happy that all these features are finally out after months and months of anticipation, but it's also kind of bittersweet because right now I'm a bit busy and I don't have the time to mess around with it a lot and give a very thorough review. And what makes it even worse is I've recently been getting some survey emails from Robinhood asking for my opinions and all that. And I really want to give them an in-depth review, but unfortunately it'll be a few weeks minimum before I could do that. But definitely I will be messing around with futures and index options in the future. Starbucks was another stock that I briefly wanted to talk about. So it seems like the market reacted very positively to Starbucks' recent earnings. And I haven't really been paying attention to a lot of what the media and other like content creators or people on X have been saying about the company, but I'll just give my 2 cents on not just Starbucks, but cafes and coffee shops in general. So one of Starbucks' biggest problems, in my opinion, as to why their foot traffic has been down or why their stock and just their financials in general have been underwhelming in recent years. In my city in particular, I have noticed myself going to a lot more local cafes where the prices are cheaper, the quality is better, and the quantity is better. So it doesn't really make sense for me to go to Starbucks when I can go to a local shop that is much cleaner, much more interesting because it has a little bit more of that local flavor, right, as to the aesthetics of the shop or whatever. But they also have higher quality food that is not only cheaper than Starbucks' food, but they also give you more bang for your buck. Now, one of the shops, I've noticed the average ticket price whenever I go there tends to be much lower than Starbucks and other cafes, most likely because there's no tipping there. But also the food quality is somehow much better and the quantity is much bigger. Like whenever I buy a turkey wrap, those turkey wraps are huge and they stuff them. It's not like, for example, Walmart, whenever I get a turkey wrap there, it seems like they really skimp out on the meats. But this coffee shop in particular, they pack it with me and the price of the food item is the same as a food item that I would get at Starbucks. So it's just a no-brainer for me to go there when I'm paying less money, getting more food, and it's higher quality food. Now, the second local shop that I go to in my town, the ticket price is much higher, but that's also because you're getting a better overall experience where the plates and the mugs, everything is like super unique and the people there are very friendly. And even though the food quantity wise may not be as much as shop number one, the quality is definitely up there. But my point is, there's just no reason for me to go to a Starbucks unless I'm going to a different town and I don't really know a lot of places, but I see a Starbucks sign. If Starbucks can turn around specifically in the food categories, then I do think they have a very bright future. Now, some of you guys in the comment section recently have been asking about what my process looks like in terms of finding good companies and picking good stocks for my portfolio. So I thought I would touch on that a little bit. But before I get into the details, I want you guys to remember, I posted a video about this a while ago, but I'll say it again. There is no one right way to do everything, right? You'll get a lot of these YouTubers or people on X or these finance gurus and influencers in general talking about how technical analysis is the way to go, or options trading is the way to go, options selling, blah, 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 or fundamental analysis is the way to go. And technical analysis is just for degenerate gamblers and blah, blah, blah. And I'm not saying that they're wrong. What I'm saying is you should take bits and pieces of everything that they're saying and just combine it into your own strategy over time as you get experience in the market. I just wanted to mention that again before I dove into my strategy, because I think it would really help you guys understand why my process is the way it is. So when it comes to investing in stocks or sectors for myself, one of the things that I like to do is just notice trends in general all around me. So it could be like some makeup brand or some shoe brand or whatever. any product that seems to be very popular around you. So the example I pulled up here is Robinhood, right? Robinhood back in 2021 was all the rage. It was in the news cycle 24/7 whenever that whole retail trading boom. And it seemed like everywhere I went, people had the Robinhood app on their phone. They were buying options and gambling, buying GameStop, whatever. So it definitely was a super popular app. And it seemed like fintech and retail trading in general was going to be growing in future years. Now, of course, that doesn't mean I bought Robinhood stock back in 2021 when it hit almost, $85 a share. Definitely, I did not buy any there. What I did was I waited for Robinhood to get down to these levels right here and start making a base. If anybody doesn't know what a base is, it's basically a period of consolidation where the stock doesn't really go anywhere. It seems like it's making this big rectangle, right? But while it's making that rectangle, if any of you guys will notice here, these are two moving averages. I think it's the 9 and 21. I don't know. I haven't checked in a long time, but basically it's just pretty lines that I like to look at. As it's making this base, these two moving averages will converge. The stock will pick a direction to go, and of course Robinhood decided it wanted to go up. So number one, Robinhood was a company that was on my radar. It was a product that I used personally. It was a sector that I thought was going to be growing in future years. The stock was making this amazing base and it was consolidating for all these years, washing out all those sellers, but at the same time, fundamentally, it was becoming a better company. And I remember specifically back in these years when it was trading at around $10 a share, it was literally at book value. The balance sheet was crazy, and I think free cash flow yield was around 10%. Now, I'm just going off of memory, so don't quote me on it, but the fundamentals and technicals lined up, and it was a product that I used every single day and a company and a sector that I thought was going to be growing in future years, which is why I bought Robinhood at $10 a share. Now, the indicator that you guys see up at the top is actually my personal indicator that I created using ChatGPT, actually. And my personal indicator is basically a combination of multiple indicators, and that deserves a video all in itself. Now, I don't want you guys to think that I'm trying to keep some secret from you guys, because this indicator, just like any other indicator, is not 100%. I'm not going to try and sell you guys some online course or whatever, but I just wanted to mention that I do have a custom indicator up at the top. Now, when it comes to fundamental analysis, some of the things that I like to look at are free cash flow per share, obviously earnings per share. I like to look at whether or not the share count is actually going down, because obviously free cash flow per share, that it's nice and all, but if you're constantly being diluted as a shareholder, it makes me a little bit uncomfortable. But if I see free cash flow per share going up and the number of shares going down, well, then that is definitely a positive. Now, the example I pulled up right here is Robinhood. And if you'll notice, back in 2023, their free cash flow per share actually turned positive into $1.30. And so basically my thought process back when I was buying Robinhood at around $10 a share was, if they can just get free cash flow per share back up to $1, that is basically free cash flow yield of 10%. And their balance sheet was in a healthy enough position where they don't have to rely on issuing shares anymore. So basically, if their balance sheet is healthy and the stock is trading almost at book value and free cash flow per share is going up, maybe this is a stock that I should buy. And just to show you guys another example, this is Honest, and I believe I also doubled or more than doubled my money in Honest. But back when they were around $2 per share, I looked at their balance sheet and I saw, okay, tangible book value per share is basically $1.50. They're trading in the $2 range, so it's almost at book value. And their free cash flow per share is starting to flip into the positive. And it's a company whose products that I think are actually really good. And if you look at the charts, just like Robinhood, the two moving averages are starting to cross over. So basically, number one, it's a company that I like, that makes products that I like, that looks really good on the charts, and they look really good fundamentally. This is a stock that I should probably buy. So basically what I'm trying to say is, over time, you guys will slowly pick up and notice things to add into your little toolbox. And over time, you'll create your own little process similar to what I have, right? So all these guys that you see online talking about how fundamental analysis is the only way to go, anything else is just gambling, blah, 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 or technicals is the only way to go and only boomers use fundamental analysis. Don't fully listen to anyone. Like, use the eyes that you have, use the charts that you have, the tools that you have, and the experiences that you have to craft your own strategy. And of course, right now it's 2025, but I've been in the market since 2019. And over time, my process has been look for companies that I think will be decent in sectors that I think are decent, that have decent setups both on the charts and in their financials, and just see if it goes up or down.